Hello and welcome to Market Domination. I'm Josh Lipton alongside Madison Mills, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell on Wall Street.
Nvidia had a great report. The information had reported, this is a media outlet, that data centers would not be stood up in Q1. That would run into Q2, completely thrown off the table last night. Several billions of dollars of Blackwell in Q4. Data centers will be stood up in Q1. That is what investors were expecting.
I think you'll see some broadening out until we get further evidence that the economy is slowing, and that's our concern. The GDP number that we got today, again, it was backward looking. It's very surprising to me that the consumer is still driving GDP, given the level of debt that they're carrying right now, as well as the high interest rates that are starting to filter into whether it's confidence or now delinquencies rising. I don't think that's very sustainable either.
The pricing, that's been a concern on Lulu, and competition has been a concern on Lulu for as long as I've been following the stock. The key for Lulu and the key to their success is innovation and the quality of the product, which distinguishes it from alternatives in the marketplace. And we believe they still have that. What we see from consumers is a willingness to pay up for quality.
We got 1 hour to go until that market closed, but we're taking a look at the major averages right now, and this is why I'm so excited to fill in the last hour. That's when you get the flips of the market and that volatility. The Dow's holding on to gains, but you got the S&P and the Nasdaq flipping into the red just in the past 15 minutes or so before the show started here. We thought that the market was going to continue to go to the upside despite those Nvidia earnings, but it's looking like we're seeing some downward pressure as we head to that closing bell.
Yeah, it's some just interesting puts and takes today. You know, you had Nvidia, solid report, solid guide, but obviously there were investors expecting more after that big rally. And then this morning with that GDP print, Maddie, I think you just saw maybe some suggestion, at least that's what some investors took away, an economy that's still decent, a consumer that's hanging in there. And of course, then you spin ahead to tomorrow, you get PCE, the Fed's preferred inflation gauge.
And it'll be interesting to see how much the market reacts to that preferred inflation gauge as they anticipate that jobs report coming up next week, right? Is the inflation data going to matter that much, given that the market is so obsessed with that labor data, because that's what the Fed is so obsessed with. But I'm fascinated to see where this goes, because we were just 0.5% away from another all-time high on the S&P for the day. Seems like we may not make it there at the moment. So we'll see.
Let's get some more smart perspective on this market. For on these moves, we're going to welcome in here Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, I actually want to start with Nvidia, Rob. I am curious what you made of that print. Solid report, Rob, solid guide. Clearly investors wanted to see more. What did you make of that report, Rob, and also the response to the report?
Well, I think in the response, what we saw is investors were somewhat disappointed with the beat, right? I mean, you had this beat of expectations on the Nvidia side. It's still fairly good news for the future there, but it wasn't quite as good as investors hoped. And I think the challenge is we may be moving kind of past that peak acceleration in artificial intelligence spending. And that's maybe some of the concern we're seeing here, that it just expectations won't be able to keep up with where the market is priced. And that's some of what I think we're seeing in the sell-off today between Nvidia, but also other tech names are getting hit as well. So I think we're seeing a little bit of rotation here in the market.
Is this a sea change moment then, Rob, or is that a little bit of noise for the day that's going to start to kind of wade as we get further away from last night?
Yeah, I'm not sure it's a sea change, because I think for us, we're still constructive on this space as we look out over the next couple of years. I think the question is, are we a little too overdone at the moment, maybe a little too overheated at the moment? Because as you pointed out just a minute ago, really attention is going to start to turn to the jobs report and the Fed, and what is the Fed doing, and how does that really help the rest of the economy beyond just technology and artificial intelligence.
Rob, you know, we got the Nvidia print. We also had that GDP print this morning, Rob. I'm curious to get your take on it. Did it suggest to you, Rob, an economy that's still decent, a consumer that's still resilient?
Yeah, resilience is one word we would keep using for the consumer, especially backward looking. Tomorrow, in addition to the PCE report, right, you get personal income. So we'll get another glimpse at that consumer as we enter the third quarter, meaning July. And I think it's important that they can they continue to keep up? It's really the consumer continues to find ways to maintain spending. And part of that is we have a very low unemployment rate at 4.3%. We continue to see job growth. Jobless claims are not ticking higher, and we've had wage growth. So consumers are really still in an okay spot to spend money. There's some signs of softness, particularly in the lower income cohorts, but that's not yet really bleeding through to the overall spending levels for the economy. So it's definitely something that is going to make the Fed's job maybe a little easier as they still probably head towards cuts in September, but the consumers maybe not as soft as people feared at the start of the month.
Did the recession come and go without us really noticing it, Rob?
Well, I really don't think we've had one in an economic sense. I mean, certainly we had last year, the first 2 quarters of 2023 were negative earnings growth years for the S&P 500. So we saw maybe an earnings recession, but I don't think we've seen a recession, and it doesn't look like we're headed into one because the consumer came into this with a strong background in savings, low credit costs. And then we've gotten wage increases and new people in the labor force. So that's really still helping the economy as we move ahead. All that still has to work through the system.
Rob, so given that your views there on the economy, the consumer, talk about how you want to position your portfolio in the equity market.
Yeah, given that we're still constructive, even though there are some risks ahead, as we highlight, right? Federal Reserve uncertainty, we could argue maybe election uncertainty. We would still tilt a little bit towards equities rather than fixed income, not because fixed income is unattractive, but rather because we think there's still growth left in this economy. We think there's still room for improvement, particularly for this rally to broaden out away from technology, maybe defensives in the near term as interest rates really start to come down a little bit here and make it easier on the real estate, on the REITs and on the utilities. Healthcare companies probably have some room to improve. So we think there's room for people to see some improvement here. In particular, we're looking towards equal weighted S&P to get away from what's been the high flyers through the month of July and into the rest of the sectors as they hopefully gain in the year end.
That's exactly where I want to go, Rob. I know that you're like an equal weight S&P. You're also recently selling off some commodities. You're adding to duration. It's giving me a sniff of defensiveness, and I'm wondering what the primary driver is of that. What are you worried about?
Well, I think we are worried about the demand condition for commodities, right? The trend in energy has been somewhat softer. The strategic, so I think we're looking at that. But you're also seeing weakness outside the U.S., particularly China. So that's hampering some of the industrial metals trends. And then we've got ample supplies of agriculture. So that's softened the commodity story. I think the other kind of concern we have is our valuations a little rich. Do earnings expectations for 2025 maybe need to come down a little bit? And that could dampen some enthusiasm for the broader market, but particularly the high flyers, which is why we're looking into those defensive sectors, into this kind of broadening out of the rally outside of such a concentrated focus on just technology and communication services.
Rob, you mentioned the election there. Harris, Walz giving their first interview this evening. I'm just curious as a strategist how you're thinking about this, Rob. Do I need to be, as an investor, ready to tweak my portfolio depending on who wins, or no, as a long-term investor, should I look through that?
So it kind of depends on what you want to look at. For us, when we look at it out for the broad market, we really don't see a big influence in in elections on forward returns for the S&P 500, right? There's sometimes some temporary issues, but really not big ones. Really what we see is markets are focused closely on growth and inflation. That's really what drives markets as we move ahead. So the key, though, will be as we get to platforms, are there impacts probably at the sector level? And that's where we see more room for investors to pay attention is, does this change the prospects for one sector or the other? And we're really waiting to see a little more both of their platforms really in writing rather than right now in rhetoric to do some of that analysis.
All right, Rob, we got to leave it there. Thanks so much for joining us. We really appreciate it.
Thank you.
Moving on to another stock we are looking at here, Gap releasing its second quarter earnings earlier than anticipated. As a result, the stock halted trading briefly. The company beating on both the top and bottom lines. For more on this, we bring in Yahoo Finance senior reporter Brooke DePalma. Brooke, a crazy day for you probably, but also for everyone working at Gap on their investment relations team. What happened today and what's the takeaway from the earnings print?
Yeah, so Gap beat on all metrics. It was a great report for the company that's really in the midst of this turnaround, but not without a bit of a headache today for the company. Earlier today, around, I'd say 9:30, the company accidentally released its report online. And according to a Gap spokesperson, it was posted for a brief period as a result of an administrative error. They then notified the New York Stock Exchange, and that was the reason for that temporary hold in the middle of the day. Now, the stock has since resumed trading, and we are seeing a bit of a pop as we approach the time at which they were supposed to release their earnings report. But moving right along, investors are pleased with these results. Like I said before, Gap is in the midst of a turnaround plan. This is the second consecutive quarter of sales growth for the company. It really speaks volumes to Richard Dixon's plan to really turn this company around. Its namesake brand Gap and Old Navy both performed well. Old Navy saw a 5% jump in same-store sales growth this quarter. Gap saw a 3% jump. Now, Banana Republic, a bit of a different story there. Of course, it's a bit more of a work brand. They said that same-store sales growth was flat there as the company plans to focus on fixing the fundamentals and working to improve its pricing and assortment structure. And Athleta, that's this premium lifestyle brand. They did report a sales decline of 4% there, and they do expect the brand to return to positive same-store sales growth for the remainder of the year. So it really sort of, taking a closer look at this report, it sort of speaks to where we're at right now. Consumers looking for deals while maybe not going as often as they used to those more premium brands.
You know what? Mistakes happen.
Mistakes that do happen.
They do happen.
Exactly. Exactly. They adjusted.
Who among us?
Eventually, we got the report.
Investors were happy. Stock popped 3%.
It's got to make the intern happy.
Josh's takeaway: mistakes happen.
I think it's just a life lesson. Thank you, Brooke. Appreciate it. All right, coming up, we're just getting started here on market domination. Shares of Nvidia lower today following their latest earnings report. We're going to speak to an analyst about the numbers on the other side. Plus, Dollar General plunging on the back of a second quarter miss. So how should you be viewing the discount retail sector? We're going to take a deeper dive with today's investor playbook. Stay tuned. Much more market domination still to come.
Nvidia shares under pressure despite posting better than anticipated second quarter earnings. Wall Street's lackluster reception to Nvidia's results stirring questions on the health of the AI boom. CFRA Research Senior Equity Analyst Angelo Zeno joins us now with more. Angelo, always great to speak with you to get clarity on what's going on in the broader tech space that you follow so closely. Is this sort of a sell the news event, or did it fundamentally change the narrative when it comes to the health of Nvidia as a company, not a stock story, but as a company story moving forward?
Yeah, no, so thanks for having me, Madison. And listen, I think more the former, right? So I think this is a situation where nothing's really kind of changed, more of the sell the news kind of event. And listen, at the end of the day, this is a company that beat their numbers, probably on the data center side, we call it about $1.5 billion or so. And then on the guidance side of things, also kind of guided a little bit above the street, but maybe not as good as it historically has done. A big reason for that, obviously, is because those sequential kind of gains at this point in time are definitely slowing. You're looking at about 15% sequential growth that we saw in the July quarter. I think that's expected to decelerate to about 8 to 10% here. Let's call it in the October quarter. So a big part of that is just the law of numbers in many respects. This is a company in terms of their revenue that has grown essentially 5x in the last 6 quarters. So that run rate is just absolutely phenomenal. We do think that, when you kind of look at how they're performing right now, specifically with the delayed Blackwell launch, that's even more impressive in our view, kind of with the momentum that we're seeing on both the H100 and the H200. And with the Blackwell launch that we expect, by the end of this year into early 2025, which will ramp, we actually see the potential for maybe even sequential growth to start to accelerate slightly from what we're seeing here in the current quarter, the October quarter.
Angelo, let me ask you, these big tech giants, Angelo, that are spending on AI, which is great news for Nvidia. I'm curious, do you see that continuing, Angelo? Any signs of a slowdown there?
So we see it continuing, just not at the pace that it has been, right? So in terms of kind of what we're looking at from kind of the biggest 5 spenders in the U.S. here in 2024, they're looking at about 35 to 40% growth. And next year, we think that decelerates closer to about 15 to 20% growth. And then I think what's more important now at this point in time is, given the questions about sustainability of kind of the NVIDIA momentum, is how does 2026 and even kind of go into 2027 look? In our view, at least as a placeholder right now, going into 2026 is about 5 to 10% CapEx growth. I think, a big question that investors have or a concern when it comes to NVIDIA, they kind of look at those kind of 70% declines that you've seen in the stock price. I think, 2 out of the last 6 years or what have you. A big reason for those declines actually is because back then, NVIDIA had a different complexion in terms of their revenue base. You're looking at about 50% or north of 50% of their revenue base tied to gaming. Now we're about 88% of their business tied to these hyperscalers, as well as kind of other data center type drivers out there. So a completely different complexion. But that said, there's clearly going to be risk looking ahead for this name.
Is that a bad thing, Angelo? I spoke with a guest yesterday who mentioned something about this, the idea that it's not a good thing for a couple of companies to be responsible for the majority of NVIDIA's revenue. Is that a negative catalyst for NVIDIA?
I think it depends on how you want to look at it, right? I'd actually personally rather be kind of tied to these hyperscalers than I would the consumer, to be honest with you. And a big reason for that is when you kind of look at the revenue trajectory of these hyperscalers over the last 2 decades, they're much healthier than the consumer themselves. So in many respects, I don't necessarily think it's a bad thing. I think it becomes a bad thing when you hit maybe a point where you're hitting spending levels that are unsustainable. But when you kind of look at these hyperscalers right now, in our view, in 2024 and even into 2025, these companies continue to grow free cash flow despite the fact that they're significantly increasing CapEx spend. And I think that's really important to note, because that continues to tell you that as long as these companies continue to have healthy end market trends, tied to the cloud, tied to digital ad spend, then it should bode well for them to continue to spend at a fairly healthy clip going forward.
Angelo, so all right, NVIDIA's come and gone. After the bell today, we got another name reporting in your coverage universe, Marvell. I'm curious what you are looking for in that report, Angelo. Is that a name I want to own?
I mean, that's a name we've liked for a little while here. We do have a strong buy recommendation on the name, so it's a name we like a lot. Not necessarily for any given quarter, because who knows what is going to happen in any given quarter. But the good thing here is, finally, when you kind of look at their non-AI businesses, kind of their more kind of legacy type businesses in areas like carrier infrastructure, the consumer side of things. Those enterprise networking, those businesses have declined 50 to 70% over the last 2 to 3 quarters. Our view is kind of the inventory correction has kind of really played itself out at this point in time, and you're now looking at potential sequential improvement here in the July quarter, and more importantly, in the following 2 to 3 quarters. So we actually think they're at a point now where they're actually going to start seeing sequential acceleration because of the unwind we've seen essentially kind of play itself out on the legacy businesses.
And Angelo, we're also anticipating Broadcom earnings next week. What are you looking for?
As far as Broadcom is concerned, I mean, I think I think they continue to do very well. I mean, this is essentially a company at this point in time on the semiconductor side of things, really tied to kind of both the compute side of things in terms of their custom silicon business, tied to Apple, which we think is ordering very nicely ahead of this iPhone 16 cycle, and of course the networking business, which is kind of the bread and butter of their semiconductor business, and we think that is kind of running on all cylinders. So as far as kind of the semiconductor business, AI is driving that business very well as Apple, and then the VMware side of things, they continue to exceed our expectations on both the cost-cutting side of things as well as kind of the revenue growth trajectory. And we don't see that changing at all as far as the numbers are concerned here for the July quarter.
And Angelo, it's had a heck of a run already. It's up more than 70% here over the past 12 months, Angelo, but you must still find valuation attractive at these levels.
I wouldn't necessarily say valuation is attractive at this point in time, Josh, but I will say this, we don't think they're egregious. So, we're kind of more in the camp of, at least with most of these kind of AI-driven names, you see some pronounced pullbacks out there. Those are where the buying opportunities are really to be found. So I wouldn't necessarily be chasing any of these names at this point in time, but the fundamentals still look really strong, especially for a name like Broadcom, we think kind of going into the print and going into 2025.
All right, not egregious. We'll take it, Angelo. Thank you as always for joining the show. Appreciate it.
All right, thanks for having me.
Now, taking a look at some trending tickers on Yahoo Finance. We've got shares, Okta shares there. Yikes, down about 20%, despite a beat on the top and bottom lines for the second quarter. Forward-looking guidance ultimately disappointing the streets. That stock under pressure. Biggest intraday drop, Maddie, since June 2023. Just reading through the report, it does sound like most metrics came in ahead of consensus. It was the company's outlook for current remaining performance obligation. That disappointed apparently some on the street. And we did see some analysts cutting the name. Bank of America, for example, does go to underperform.
I wonder what's worse for a stock. If you get really negative reaction from the bankers afterwards in terms of the analyst commentary, if you get what you got from Okta today, which is Morgan Stanley saying headline, it was fine. Bank of America headline, it was okay. Seems tough to get that kind of reaction here, and we're certainly seeing that in the price action. You can see this stock not only under pressure today, but also under pressure year to date. And Bank of America saying that the headwinds for Okta are just too big to ignore. Citi's Fatima Boulani, who is a friend of the show and a great resource when it comes to the cloud and software side of things, saying that new products are causing a bleed in wallet share rather than growing it. I thought that was a really interesting take in terms of how the company's positioning itself moving forward here.
Yeah, bulls are hanging in there, though. RBC's Matt Hedberg, he's a smart guy. We just had him on the show. I was reading through his note. He looked over the results. Chisel has an outperform on the name. Told his clients, overall, strong quarter, Matt said, and given the conservative framework, we think estimates can work higher through the year. It is tough, though. I mean, look at this stock, pull back the chart. You're down about 10% now year to date.
Yeah, really good point. All right, well, we're going to move on to Best Buy. Shares of the retailer jumping to their highest levels since March of 2020. This comes after beating earnings and boosting its full year earnings guidance. And obviously, you can see the stock here up nearly 14%. But think about March 2020. That is when a lot of people were getting that work from home stipend, rushing over to Best Buy to do at least an curbside pickup for a lot of their tech needs that they would have in their at-home offices. And to see the stock reacting similarly to such a global event, I think is really telling. In terms of some analyst reaction, they're saying that there's light at the end of the tunnel for Best Buy. They still have not returned to growth. So that's going to be the key thing to watch here. Will they return to growth mode? Are they still on track for that? It sounds like they are based on the earnings print here.
Yeah, CEO Corey Berry saying customers are seeking value and sales events, but willing to spend on high price point products when they need to or when there is new compelling technology. Goes on to say, I would argue by the back half of the year, you're going to see a much larger percent of that computing and tablets business have some kind of AI enablement immediately that will start to make more price points available. And of course, very soon, you will expect Tim Cook to take the stage, Manny, and unveil that new AI-enabled iPhone.
Yeah, I thought that was really interesting, the AI-enabled chips.
For sure.
Yeah.
All right, now taking a look at shares of HP after its third quarter results. You can see up about 2% here. Company missing earnings estimates, however, posting a sales increase for the first time since 2022. So shares moving on that. You did see the first sales increase in 2 years. Still some headwinds to cut its full year profit outlook. Headwinds in that printing division. Our own Brian Sazzi spoke with HP CEO Enrique Lores, who said that the company will be more aggressive with cost cuts to improve profits, mostly in that printing business.
Yeah, it's interesting. Shares were up nearly 5% earlier, so we are pairing some of those gains for HP right now. But again, I think this is an interesting story when we're talking about Best Buy as well, that we are seeing perhaps a cyclical, but a return to some sort of growth when it comes to PC sales. And by the way, we also had Apple up 2.5% today. I have a feeling that that is driven by some other factors within big tech news that are related to Nvidia results. But I think it's interesting to think about how PC sales in general could be a catalyst for a batch of these tech names.
Yep.
Another number here that we are tracking is mortgage rates. The rate on a 30-year fixed falling in the last week to 6.35%. That is the lowest reading since May of 2023. And that's according to Freddie Mac's chief economist, saying the decline in rates over the last week are a result of increased expectations that the Fed is going to cut rates. This news could start bringing potential buyers off of the sidelines, but there are, of course, still hurdles. We've got stubbornly high prices and tight inventories, and this is the key thing, I think, for the Federal Reserve. And I know we've talked to so many guests about this over the last few years. Has the Fed mattered as much when so many people are tied up in their mortgages, and that has led to a crush on housing supply? Will it matter when they cut rates if prices just go up and the system just keeps rebalancing?
Yeah, so average for 30-year fixed 6.35, right? So it was 6.46 last week. One, you wonder how much more they can fall, at least in the near to intermediate term. And then, just against the backdrop of what is still just a tough housing market. I mean, you have relatively low inventory, and that means prices still near records here.
Do you regret buying recently,
I got locked in
Josh?
at 6.5. I don't feel that great about it. I don't think I got a deal. No.
But maybe the price would have been worse.
Maybe the refinance.
We don't know.
Maybe soon.
You'll
Who knows?
refinance.
Who knows?
You'll date
Yeah.
the rate.
It's
All
going
right.
to work out.
We'll talk about that amongst ourselves after the break. But coming up, shares of Kava taking a hit after a downgrade from Morgan Stanley. We're going to dive into the note and some other calls of the day when market domination returns. 27 years ago today, Reed Hastings and Mark Randolph founded a company based on one idea: to sell and rent DVDs online and then mail them to customers' homes. They called it Netflix. In 2002, Netflix went public for $15 a share. By 2010, it had pivoted to streaming. Netflix then began creating original, award-winning content with popular shows like House of Cards and, who could forget, Orange is the New Black, Josh.
Today, it has nearly 280 million global subscribers, 265 Emmys, and 23 Oscars. And by the way, if you invested $1,000 in Netflix in 2002 and left it there, you have about 690,000 today. According to our next guest, Netflix still has more room to grow. Joining us now is Mark Mahaney, Evercore ISI Managing Director, Head of Internet Research. Mark, it is always great to see you. On Netflix, you recently did, Mark, some interesting detailed survey work, which clearly left you feeling confident about this name. Walk us through that survey work, Mark, if you could. Just give us the highlights.
Yeah, and thanks. I didn't realize today was the birthday of Netflix. That's a fun data point. And it really is amazing to see. I mean, they did start the business with the idea that they would be streaming, but you couldn't have physically streamed anything 27 years ago or 28 years ago, whatever it was. So you talk about visionary. I mean, they were thinking about an industry that didn't even exist when they started the company. Good for them. Anyway, we've done quarterly survey work in the U.S. for 11, 12 years now. And we've done annual work in international markets. This time we looked at Mexico, but we look at a lot of different ones. We test for a couple of things like penetration or selection. How many people are selecting Netflix as their go-to streaming source? And then what's the satisfaction level like at the company? What's the intent to churn? And we've tracked these metrics over the years, and not always, but they've generally gone up and to the right, but not always. In this most recent survey, we keep seeing Netflix as the leading streaming option for consumers in both the U.S. and in international markets, in this case, Mexico. There is rising price sensitivity. We've had some price actions taken across the industry recently, so that always leads to a little bit of extra churn. You're also getting much more mature, not saturated, but mature in the market, so that's going to cause churn to be more likely. You're well past your early adopters, and you're kind of into your average or even late stage adopters. But all in, maybe the last point I'd make is that the standout differentiator for Netflix continues to be the quality of its content. When you really press people in a survey on where do you find the actual best content, the best shows, it's always and very consistently been Netflix. So yeah, that keeps us constructive on the stock. It's not one of our top picks because of valuation, but we're constructive on it. We see a path to like 750, and that's not huge upside from here. Yeah. Maybe 10%, maybe.
Well, Mark, I love that you point that out in your note. You say that the 750 price target, it doesn't imply dramatic upside, but you still sound fairly bullish on it. At what point, though, for investors, do you think, okay, the biggest gains we were going to get are kind of already past us here because Netflix can only grow so much? There's only so much market share that they can take up.
Well, then, Madison, the question investors have to ask is, can you identify kind of new growth initiatives that can kind of bend the curve again? And there's two that I think of with this company, maybe three. The first is live sports. So we're getting the NFL on NFLX on Christmas Day, and that's a pretty big moment. Now, they've had live events, live comedy. They've had some unusual sports events. I think you got the Tyson fight, coming up on Netflix. But that, if Netflix today is about 75 million households that are subscribing, my guess is if they were to really pick up a big live sports presence, you'd probably get 10, 20 million more households signing up for Netflix. So I think that's a interesting new growth area. And then gaming is another one. Believe it or not, there's we see this in our surveys, rising usage of Netflix. There's a fair number of games on there. Some of it comes out of their own original IP, intellectual property. And then third is the ads business is still a ways away from really moving the needle for Netflix. It takes some time. They have to build out the user base, but I think those ad dollars are coming. They just haven't. I give them a B on how they've done so far in ad revenue. So I still see like two or three of these drivers. And I essentially, I want to stay long the stock. Am I an aggressive buyer here? No. Would I be at 600? Yes. And in this market, you can always get these kind of clips. You had one earlier this year. So to me, I view it as high quality. And if it gets dislocated down, 10, 20%, that's when I usually step in and making an aggressive buy. But it's a good asset. You want to stay long in.
Mark, you think price increases could be on the way? I mean, even if they do, Mark, I'm not going anywhere. To your point, content's too good. Baby Reindeer, Ripley, I'm totally hooked. But what kind of price hikes could I be looking at, Mark, in your opinion, and what would it mean for the business?
Well, this company generally has taken price up over the years. That sometimes that's been problematic for them. They have to get the metrics right. So if they can really see internally rising satisfaction, rising engagement, that kind of gives them a little bit of the green light to raise prices. But you have to be careful how you do that. You better have a better value proposition. You're gonna have to justify that to the consumers. The open question I have is, I think they'll take price, whether they'll do it on the lowest price point in the industry, kind of that $6.99 ad-supported service, or whether they'll do it on their $15.49 standard plan. And these are U.S. prices, but I think they'll do it globally. I don't know. I don't know quite what their strategy is. I think what's really caused the sub growth to really reaccelerate the last 2 years, dramatically reaccelerate the last 2 years, has been the rollout of password sharing crackdowns and the ad-supported plan. Netflix got cheaper for everybody. $10 too much for you? How about $6.99? By the way, that's the cheapest price across the entire streaming industry. For the simple best package out there, you get more content for your $6.99 than any place else. It's a steal of a deal. Whether Netflix wants to keep that as a steal or not, I don't know. I think they could take up that price or the $15.49. But I do think you will see more price increases.
Mark, always great to have you on the show, my friend. Thanks for joining us.
Nice to see you.
Time now for a look at some calls of the day. Morgan Stanley downgrading Kava despite still being positive on the brand and the narrative for the company. You can see the stock's down about 5% here. So Morgan Stanley there, they do downgrade to equal weight, so they move to the sidelines. They do sound generally positive on this name. Upward revisions likely, but this does seem well anticipated is what they told their clients, that Kava's pulled forward growth, profitability, cash flow. Says the market is assigning a higher probability to broad national success than it did a year ago.
Yeah, Josh, it's fascinating. When you look at the chart on your screen here, you can see Kava's up 160% year to date. And they even talk about this in their note. At the time of writing it, the stock had rallied 200% year to date. And so they say, listen, yes, near term, we are constructive. But if you're someone owning this stock and you look at this note where Morgan Stanley is saying, yeah, this is no longer a fresh money buy, no longer seeing upside to the price target, that might be a tough signal in terms of the outlook. And by the way, this comes after all those executives selling their shares. So that's also sometimes concerning for shareholders.
Street fairly divided on this one. 7 buys, 8 holds, 1 sell. Stock, of course, has been just a monster. What a move.
Yeah, very true there. All right, well, Pure Storage also disappointing Wall Street with its third quarter and full year outlook. TD Cowen, Citi, and Piper Sandler all lowering price targets on the stock. You can see it's down nearly 15% here. Now, just as a reminder, Pure Storage, as the name might imply, it's pure storage play in the space. It reiterated that full year outlook, but that was not enough to make the bulls happy. It offers products on a subscription basis also, and those subscriptions are under pressure. And this is something that has been a key economic indicator as we're seeing companies sort of pulling back on their subscription payments as an effort to sort of control their balance sheets, as we are unclear about the path forward for the Fed and the economy. And that is the exact type of decision from small businesses and medium-sized businesses that can impact a company like Pure Storage here.
Yeah, enjoyed a strong move, Matt, so we should point that out. It's still up about 40% so far this year. Analysts giving their takes, team at TD Cowen remain bullish. The company reiterating its full year outlook wasn't enough to satisfy the bulls, they say, but a hyperscale design win, which management remains confident about, should improve sentiment in our view. All right, moving on. William Blair initiating coverage of Tesla with an outperform rating. The bullish call highlighting the EV maker's underappreciated energy storage business, noting an Apple-esque ecosystem for energy. And joining us now is Jed Dorsheimer, Group Head of the Energy and Sustainability Research Sector at William Blair. Jed, interesting note. Why don't you walk us through the initiation, Jed?
Sure. Thanks for having me. The key, it's really about a culmination of 9 months work. looking at our energy systems in the US, how the grid operates, and particularly the role of artificial intelligence and what that does to stress the grid. And some of the findings are that, the move to renewables, which are variable assets, are actually increasing the fragility of the grid, which is causing a consequence of one of Tesla's products, the Megapack, to add storage to actually stabilize the grid. So we see, the two benefits from this reduced resiliency is one on natural gas, which benefits one of the names we also launched on, which is GE Vernova with an outperform rating, and also Tesla for the energy storage or the Megapack. And that doesn't get a lot of attention. It's most of the focus on Tesla is on its EV side, but we actually think that the growing energy side could add, close to $3 of earnings to the business.
Jed, it's a fascinating outlook, but I wonder if you need to call Elon Musk and see if he is on board with this future of the business here. He has said previously, if you don't see Tesla as a self-driving car play, you shouldn't be owning the stock. How much does your view require Elon to kind of get on board with the future of the business, relying on something else here?
I mean, I've had several conversations with Elon, not recently, but in the past, and I think Elon has always seen the business as an energy play, and that takes different forms. So I would doubt that he would have pushback on. I have not had this discussion with him. But I would be surprised if he views the company or views this asset that they have, which is growing. I mean, literally, they're sold out and can't build capacity fast enough. If he would view that as a negative. I do think you bring up a great point, though, which is, the EVs, which is, I've covered this in the past, and we look at the company holistically, get all of the attention. And so this is an area that we're bringing focus to that is often overlooked. It does not get a lot of attention. And one is because historically that's been rather small, but we see this as a growing, both growing in demand and value and importance for Tesla.
You also mentioned you had GE Vernova. Before we let you go, I also want to get your take there. Why is that a buy?
Best way to invest in renewables is to own natural gas. I mean, the variability is creating havoc within the system. You just had the PGM, which is an auction, show that prices were up 833% year over year. That's going to push 26% increased prices to consumers in the Dominion region, so Virginia, Baltimore area. And so as the leader of natural gas turbines, which is dispatchable power that avoids some of these issues, GE is going to, and that's their most profitable business on the services side, that is going to continue to drive profitability and visibility, which is 10 to 15 years for most of these contracts. So we really like that name for the nat gas and the power gen, which is somewhat contrarian and controversial, but I do think that that's why we like that name.
Yeah, William, I'm fascinated by this line you have in your note, and I'm going to let you read it, but you talk about how Tesla and GE are good AI plays, Jed. So I'm just curious, should the people that are worried about their Nvidia holdings over the past 24 hours be viewing those two names as the next big AI play, in your view?
Well, 100%, but not for if you don't have energy that increases, then your AI play will not work. Because large language models require, on average, 200 times more energy per search than traditional search. And crypto, no matter where you come out on that, 300 orders of magnitude more than a traditional Visa or MasterCard transaction. So no matter how you look at AI or where you come out on that spectrum, it's going to require more data centers, and that requires more energy. And if you cut the lifeline of the energy off, then quite frankly, that will not work. There's no possibility.
All right, Jed, I was so enwrapped in your note that I was looking down at where you work, William Blair, but thank you so much for joining us,
No problem.
Jed.
Thanks
really
for having me.
It. Thank you.
Thank you.
Now coming up, Dollar General plunging on the back of a second quarter miss. How should you be viewing the discount retail sector? We're taking a deep dive with today's Investor Playbook. Stay tuned. Much more market domination still to come. Dollar General shares cratering, down 30% after the company reported disappointing earnings and slashing full-year guidance. The company's CEO saying its core consumer is cash-strapped. Joining us now, we've got Piper Sandler Managing Director Peter Keith. Peter, great to speak with you, and we just got your note on this, but I'm taking a look at the stock here. It's down over 40% in the past 5 years. It's down over 40% in the past year. To what extent is today's earnings print from Dollar General a new story for the company or a continuation of the same downward trend?
Well, I think it's a bit of a new story. And just to give you some background, I mean, the stock had been underperforming for the last 18 months or so. It really kind of, they sort of blamed 2023 on more internal execution issues. You had a former CEO then come back last October to kind of save the day. And so here we are now, kind of like, I don't know, 9-10 months after the CEO has come back and had this turnaround plan, and all of a sudden the fundamentals step back again. And so it feels like kind of a new change in that this is really becomes now a bit more of a structural issue, potentially for Dollar General and really maybe for the dollar store channel as a whole. Certainly the Dollar Tree and its Family Dollar concept also seem to be having very challenged results.
I'm interested, Peter, given the customer base here, Walmart seems to be faring okay. What are the differences there? Are there differences in leadership, execution?
Yeah, look, I think, if you'd say what's the issue at Dollar General, I think, Walmart is one of the key problems. I think Walmart's this giant vacuum cleaner sucking up a lot of market share. One thing that Walmart's done exceptionally well is build out a very compelling digital strategy. It combines, its brick and mortar retail stores with its own online website. And I think that's very appealing and convenient to a lot of middle and upper income customers. So when we're in this little bit tighter consumer spending environment where normally Dollar General would be picking up market share, seeing what they call trade in or trade down, new customers coming into Dollar General, that's not happening. Those customers are going to Walmart because they like the digital capabilities. And frankly, the Dollar General, the dollar store model isn't very digital. They don't have a robust e-commerce offering. So it just doesn't have that same digital convenience that a Walmart does.
So what do they need to do moving forward? Is it about execution, like you've mentioned, Peter, or is it about something that's a little bit more fundamental to the consumer that they're catering to?
Well, certainly. So there's two dynamics. You're not getting the trade down, and then their lower income customer cohort, which is about 60% of the business, then they're more pressured. So some of it will be, if the economy picks up, maybe jobs get a little bit better, inflation is reined in, that lower income customer cohort will be better and will have more money to spend. But ultimately, when we think about Dollar General and the dollar store space, we do think they need to build out a more robust digital playbook. That if they want to get younger customers, they want to get more middle income customers, there are certain basic things around digital shopping and e-commerce that are just demanded these days. And frankly, this is an area where Dollar General does not have. They said actually on their call today, this might be an area where they're not picking up share. So stay tuned. They'll have more to say about that at a later date.
Peter, I want to switch gears to another name you cover, Best Buy. I'm curious to get your read on that report, Peter. Investors obviously liked what they heard.
Yeah, I can't opine too much on that one. We haven't published our summary note, but just to give you some factual information, there were some concerns on the same-store sales going in. I would argue that the same-store sales that came in, it's still negative, but a little bit better than expected. And then the company said that August was actually running flattish. So kind of Best Buy has been in a negative sales environment because of very weak demand for, frankly, about 2.5 years. And you're starting to see the same-store sales move towards this flattish, more stable trend.
Where are you getting clarity, Peter, on the health of the consumer? Because we've danced around this idea, but I can kind of pick any different retailer and tell a different story about the health of the consumer. And I think it's really interesting in your Dollar General note, the story that you paint about the lower income consumer. They're struggling to pay with rent and utilities, and so they're not able to afford the expenditures that they typically had at Dollar General. But that's a very different story than what we've heard from some of the other retailers catering to other income groups. Where do you get clarity on the broader thesis about the economic situation for consumers?
Yeah, it's a great question. I'm kind of laughing because we're about 85-90% through earnings season at this point. We're almost done, and yes, there's got a lot of different feedback from companies on the economy's terrible or the economy's fine, the consumer's fine. You go back to the Walmart announcement, they had very robust 4% same-store sales growth. They said, we're seeing no change in the consumer. But you have a lot of other companies and Dollar General today saying, we think our core customer has gotten worse. I think you're definitely seeing this bifurcation where lower income customers, because of the inflationary backdrop the last couple of years, have become more squeezed. And so their spending is more pressured. When you think about middle and upper income customers, there's a little bit more of a buffer as it relates to those inflationary pressures. Stock market's been good, home prices have been good. So people that own those types of assets feel a little bit better off. So I think those companies that cater to middle and upper income are doing better than those that cater to lower income. And then certainly, there's just customers that are ideally positioned today. Ollie's is another company I follow. They're out today. They are seeing trade down. They have closeout pricing, so they have great value. Other companies have maybe some type of innovation or great value offering that's resonating with consumers. So it's very mixed right now. I agree it's concerning. I think the bifurcation I mentioned is the biggest dynamic that we can point to.
Peter, so good to have you on the show today. Thanks for taking the time to chat.
Thank you both.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including a full slate of earnings reports from the likes of Dell, Lululemon, and many more. Stay tuned for Market Domination Overtime.
That is your closing bell on Wall Street. And now it is Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's do a quick check at those major averages and where they ended up here. So you're taking a look as we wait for us to get those final numbers here in our board here. But you're taking a look at the S&P right now just over the course of the day. And it really took a turn as we headed into our last hour of the trading day. Here you can see the S&P was just half a percentage point away from making another all-time high. That was indicative of this idea that the market did not require Nvidia to be in the green for the broader market to rally. But as you can see, that lost a little bit of steam as we head into the close here. And you can see obviously the Nasdaq under more pressure as we saw a little bit of a turn in some of those big tech names. Lastly, I just want to check on the VIX because I find it fascinating the degree to which we saw volatility going down throughout the day. That is also to me an indication that the Nvidia story is no longer the key story for the broader market here. And you can see that that is a big decline in terms of volatility for the VIX off of that low, that high rather in August during that market rout. But we're going to get to Jared Blickery for a look at the sector action in the market today. Hey, Jared.
Hey there, thank you. And let me just point out, we're going to put the Wi-Fi Interactive behind me. The S&P 500 equal weight closing up about 1/3%. That's 2.5% for the month. But just kind of highlights how we have seen the rest of the market, to your point, Maddie, just kind of reactivate here. Also want to highlight the U.S. dollar has been up for a couple days in a row. Josh and I are going to explore what that means in about 30 minutes on a deep dive. But here's the sector action as promised. So here's what happened today. Energy in the top spot, up about 1.25%. Following that, you have financials, then you got industrials, utilities, materials, and healthcare. That rounds out the top row. And then tech was the biggest loser, down about 0.9%. Staples, real estate, and communication services also in the red. And it's really been about the cyclicals this week. You take a look at the top spots. This is 4 days now. Financials, energies, and industrials. That's another thing Josh and I will get into shortly. But just to show you, to close here, what happened in my leaders for the day, it was actually KWeb. That's Chinese internet stocks that were up the most, up 2.5%. And let's just go to that China board real quick. We have seen a lot of weakness, and also mentioned that Chinese shares trade on different fundamentals than U.S., but I haven't seen a green board like this over in China in quite some time. So Pinduoduo clawing back some of those steep losses that we had only a few days ago in that post-earnings route. Guys?
All right, thank you, Jared. Bitcoin in the midst of 4 straight days of losses, with crypto becoming a major issue in this presidential election. Where can we expect the price to go from here? Joining us now for more is Anthony Pompliano, founder and CEO of Professional Capital Management. Anthony, it is good to see you. So you look at Bitcoin here, we're down about roughly 5% in August. We've kind of been trading in this range, Anthony, roughly 50 to 70,000 for months. What do you think breaks us out of this range, Anthony? Would you be looking to a Fed cut in September? Is it election volatility? What's on your radar?
I think there's 3 main things that will break us out. First is time. People are away for the summer. We kind of go sideways historically over the summer. When people come back, they sit in front of their computers and they start buying assets. And so I think that Bitcoin will be a beneficiary of that action. The second thing, obviously, is a Fed cut. As cheap capital comes into the market, you should see some of that capital flowing into risk assets like Bitcoin for people on Wall Street, and you'll see price kind of break out. And then the third thing is I do think that if former President Trump is reelected, there's a lot of folks who are kind of looking at him as the pro-Bitcoin or pro-crypto candidate, and I would expect Bitcoin to rally on his reelection as well.
What would change your view on that, Anthony? If we know, for example, that Harrison Waltz had their first network interview this evening after announcing her campaign for presidency. What could she say in that interview that would make you think that she is the pro-crypto candidate?
I don't think anyone in the Bitcoin and crypto industry cares about words at this point. If you're sitting vice president, then you can do action, right? And I think that's really what people are looking for. And so if people believe that the current administration has been abrasive towards the industry, I think the most powerful thing that Vice President Harris could do is to start to take actions to support the industry, show rather than tell. And I think the same would be true if it was a Republican in office. At this point in an election cycle, both candidates are going to say a lot of things, but the average voter really can only take those words as perceived empty promises. And so the advantage that Vice President Harris has is she can not just talk, she can act. And so if she was able to take 1 or 2 different actions that showed she was becoming more sympathetic and kind of pro-Bitcoin, pro-crypto, I think it would really help her election campaign.
Anthony, isn't that the SEC? Isn't that their purview?
I think that obviously regulators are a big piece of kind of what happens in the United States, but there's plenty of stuff that the president could do. Some of it could be via executive action. Some of it could just simply be coming out in support. One of the things that I don't think people have given enough credit for to former President Trump is he actually held a meeting with Bitcoin miners, and he sat and he listened to them. And so again, it was behind closed doors. It was attached to a fundraiser. So there was definitely incentives for him to do it. But sitting in a room and listening to these people is pretty powerful. My understanding is that there was recently a private meeting of crypto executives and some congressmen and senators that were on the Democratic side, and they wanted to talk about crypto, but Vice President Harris didn't attend. And so again, obviously politicians are busy. They've got a lot of stuff going on, but I think part of action could just be showing up and listening. And so, again, I do think that Vice President Harris has an advantage in that she's in a position to act, whereas former President Trump is kind of on the outside looking in. But let's see what happens. That we're still 2 months or so away from the election.
I'm curious, Anthony, when you're talking to friends and family, and maybe they're curious about investing in Bitcoin, and they're asking you why they should. What do you tell them, Anthony? What's the reason? Is it for the trade, store of value, medium of exchange? What's the reasoning?
Usually I just ask them, do you think the dollar is going to be worth more or less in the future? Almost no one I've met thinks that the dollar is going to be stronger in the future from a purchasing power standpoint. And so immediately they start to think, well, where can I go to get some sort of economic security for the hard-earned wealth that I've been able to accumulate? And there's many assets that you can go buy. You can go buy gold, you can buy Bitcoin, you can buy real estate, you can buy stocks. And so each person's situation is different. But I do think that there is a cohort of people and a growing cohort, hundreds of millions of people around the world. They want something that is a store of value that leverages sound money principles. It's an asset that's outside of the legacy financial system. No one can create more of it. But also they don't want kind of the existing physical gold, which is simply kind of trading sideways. Gold just hit a new all-time high, but it's only up 50% since 2012. And so you can think of Bitcoin as gold with wings. It gives you that same downside protection, that same kind of purchase power protection, but it also has the asymmetry of an asset that is compounding over that same time period at about 62% compound annual growth rate for the last 10 years.
Gold with wings. I need that on a t-shirt, Anthony. That's going. Let me ask you this. What about ETF adoption? Just switching gears a bit here. I'm curious to get your take on the launch. Flows have actually been relatively strong, Anthony, even when you see price declines. What does that tell you?
Yeah, I mean, obviously, people want access to this asset. What's unique about Bitcoin is historically technologies are adopted by kind of militaries first, then countries, then corporations, and then individuals. Bitcoin has been the reverse of that. We have seen the individual adopt it first. Eventually, we got some corporations and financial institutions, and the promise is that we're eventually going to get, countries and militaries to participate as well. But I do think that right now, as we see those financial institutions, those corporations, and kind of larger family offices want to allocate to the asset, the ETFs provide a really low-cost liquid way to do that. And so they're going to continue to buy. Now, of course, prices go up and down based on buyers and sellers. And so there's more sellers than buyers, but that doesn't mean that the folks who want the ETF are going to, go away. It just means that there's more people selling than buying, and maybe they're selling in the spot market while these folks are going and buying the ETFs.
To what extent, Anthony, do you worry about government sellers of cryptocurrency? For example, we saw that this was a headwind for the price of Bitcoin when Germany was selling off their holdings a little bit. Is that something that investors should be looking at moving forward?
Imagine being able to tell your grandchildren that you bought Bitcoin sold from a government. That's what I think. And so if the governments are going to sell it, I think people are scrambling to be the ones to buy it. Historically, the Bitcoiners have usually talked about things like, hey, don't be the Bitcoiner that sells your Bitcoin to Wall Street. Don't be the Bitcoiner that sells your Bitcoin to a nation state. But now when these governments go and they are offloading Bitcoin, somebody's on the other side of that trade. And so while it's somewhat of a meme, it's somewhat of a kind of funny conversation, I do think that there's a lot of people who say, hey, if these organizations, these nation states have Bitcoin and they're going to sell it, I would love to be on the other side of that trade. And so, there's a persistent bid. Obviously, hundreds of millions of people around the world believe that these sound money principles in digital form are very valuable. There is a very strong holder base of Bitcoin. More than 50% of Bitcoin hasn't moved in over a year. And I think that this asset will continue to do that for the years to come.
All right. Anthony Pompliano, thanks so much for joining us. We always appreciate your insights. Thanks for coming back with us.
You got it.
We're going to take a look at shares of Dell now as its second quarter results hit the wire. Taking a look at the numbers here, you can see the stock is having a positive reaction. I'm going to tell you why right now. Operating income was the key figure to watch as operating margins fell by double digits in Q1. That number came in at $1.3 billion, and that was above the estimate of around $1.27 billion here. Also, Dell 2Q Infrastructure Solutions Group revenue coming in above estimates at $11.6 billion. billion. The estimate was 10.5 billion. We're also seeing second quarter adjusted EPS coming in above consensus here at $1.89. The consensus was $1.71. And lastly, let's get to that revenue number you're seeing on your screen here, coming in at $25 billion, and that is above the estimate here of $24.12 billion, Josh.
Yeah, you make a beeline for that ISG segment because that includes the server business, and just looking at some of the executive commentary around that, they say our momentum in ISG is a significant tailwind. They talk about record ISG revenue of $11.6 billion. They say that's up 38% year over year. You're going to want more color, obviously, about the core business, so that's servers, PC, storage, but you're going to have a lot of questions on the call about AI server momentum too, shipments, backlog, and margins.
Yeah, and they get to that right at the top of the first page in their earnings print here, saying server and networking revenue was a record $7.7 billion. That is up 80% with demand growth across AI and traditional servers. Yep. Storage revenue had a little bit of pressure here, but the quote that I'm looking at from the COO here saying our AI momentum accelerated in the second quarter. They've seen an increase in the number of enterprise customers buying AI solutions each quarter here. So continuing to see that move to the upside on AI spend.
All right, let's talk about another name that's also moving higher in the after hours. That's Marvell Technology. Let's get to those numbers. Q2 adjusted EPS 30 cents. That's a beat. The street was at 29 cents. Q2 net revenue 1.27 billion. That's also a beat. The street was closer to 1.25 billion. Now looking ahead, they're looking for Q3 adjusted EPS 35 to 45 cents. The street was at 38 cents. And for Q3 net revenue, their forecasts are calling for 1.45 billion to 1.46 billion. The street was at 1.4 billion. That name moving higher in the after hours. Remember, Marvell makes chips for data centers, for networking, and other equipment. Investors, though, also very interested, Maddie, in its AI chip business, where they help customers make custom chips for AI, compete with the likes of Broadcom there.
Yeah, just a quick word search in the earnings release here. I'm only seeing 2 mentions of AI directly, so that's a pretty light one here, but they didn't need to rely on it too much. I want to pull out a quote from the CEO saying that second quarter revenue grew 10% sequentially, driven by strong demand by none other than AI. We saw strong growth from our electro-optics products and our custom AI programs beginning to ramp up. So that's really interesting, given that there's been this question for a lot of these companies about AI expenditures and the ROI on AI. You can certainly see, at least in this result, that there is that return on investment for the AI side of the business here. And interesting, they say with the consolidated revenue, that's forecasted to grow 14% sequentially. So certainly seeing continued growth here.
Yep.
All right, well, coming up, the earnings fun continues. We're going to get you the latest numbers from Lululemon and Ulta Beauty. Stay tuned for that on the other side of this break.
Nvidia reported Q2 earnings Wednesday, beating on the top and bottom lines, but after several quarters of blockbuster blowout results, the numbers still weren't good enough for many investors. So the big question is the AI trade already cooling off? Well, joining us now to talk about it is Bradley Tusk, Tusk Venture Partners founder and CEO. Bradley, great to see you.
Yeah, thanks for having me.
So I'll start right there. Nvidia, sure. I mean, it was a solid report, solid guide, right? Yeah. Obviously, investors wanted more. I'm just curious how you thought about it, Bradley, and just what you thought it made of the broader AI trend.
Right. I mean, the funny thing is it exceeded expectations. Right. It exceeded, a couple of days ago when we were looking at like, okay, where does Nvidia need to get to make investors happy? Mm-hmm. It hit that and then did better. And so really it sort of, I think, speaks to a slightly broader concern, which is at the back of investors' minds are starting to wonder like, hey, are we overinflating this? Is it going too far? Because they couldn't have really done any better than they did. It's unreasonable. It's like, it's your fault. It's not their fault. It's a question of, are they overvalued? And that's collectively our fault, right? They're going to take as much as they could possibly get. That's human nature. So the question really becomes, and one that I, as an early stage tech investor, keep asking is, okay, we understand that this is transformative technology. Are the revenue streams there? So for example, we saw this morning after that OpenAI is raising again and at over $100 billion valuation. I'm not entirely sure what the revenue model is, right? Maybe they're just selling information off of the LLMs to other AI providers. Maybe they'll turn into a version of search like Google and have ads. But it's a lot of this sort of like, oh, it's gonna be incredible, it's gonna change everything. But at some point, there's gotta be revenue. So like I have found that I've said no to the vast majority of early stage AI deals that have come my way because it keeps being like, okay, we want $100 or $150 million valuation for a Series A, a company with $1 million in revenue or $2 million in revenue. And like, that's crazy, right? And like, I understand that like, it sounds cool to be investing in AI, but ultimately like my job is to return capital to my LPs. And if I'm investing at wildly inflated values, I can't do that. And so I wonder if the same hesitancy that I'm feeling a little bit on the early stage venture side is a little bit of what we're seeing in the market today with Nvidia.
Well, let's go to that OpenAI valuation. The company and reports that the company is closing in on a new funding round that could value the company at $100 billion, as you mentioned. Some of those investors, Apple, Microsoft, now we're hearing reports that Nvidia could be involved. If you were to get a call from the CEOs of those three companies right now, what would you tell them?
I mean, look, I think the question is, what's the strategic value for you in having a role with OpenAI? What they all might say is, look, we want a seat at the table. We want to know what they're up to. We don't want all of a sudden Microsoft taking this thing, going off in a totally different direction that we can't compete with. So therefore, it is worth it to us, regardless of whether or not the $100 billion valuation becomes worth 50 or 150 or whatever it is. If that's the point, yes. But if they're like, no, this is purely a play because we think this is a great investment and we think it's going to $1 trillion, my question to them would be like, okay, based on what? Like, yeah, Sam Altman's a wildly impressive person. ChatGPT is certainly a cool, impressive piece of software. But right now, like, they don't make any money. I mean, there's a little bit of a pro feature that people could buy. So I'd want to know.
Is it a hedge, though? Sorry to interrupt. If
but that would be the strategic argument, right?
They don't want ChatGPT to take their lunch.
Yeah, that would be you're buying in to get intel and potential partnerships and influence and things like that, and you don't really care what happens to the investment itself. And look, we see in my business all the time, strategics invest at valuations that, if you were a venture capitalist, you wouldn't do because they don't make sense, but in terms of the bigger picture for them, might be just fine.
Well, I'm curious, as a venture investor, you meet with these founders, Bradley, and they're talking to you about this wild, amazing, and AI-enabled product or service. How do you actually try to distinguish between what's real versus marketing fluff? I heard a smart venture investor once say, he said this, he actually said it's simple. He said, how in real estate, it's location, location, location. For me, it's just founder, founder, founder. That's what I look for. Is it that simple?
Yes and no. So look, as an early stage investor, you're always betting on the founder more than anything else, right? We're investing in companies that will have somewhere between $500,000 and a couple $1 million in revenue. So, it's not like all of a sudden you're asking Apple, like, what are the underlying mechanisms that you're looking to evaluate OpenAI, right? So yes, it's founder, but also I think to me it's differentiation. So like I get pitched, for example, because our focus is sort of regulatory, like all these AI companies are going to show everyone how to comply with AI, right? There's 100 of these startups out there. And the problem is I can't figure out how any one of them is different from the other 99. And so like in theory, it's interesting. But for me, when I'm looking at saying, okay, is there a regulatory angle here that will give my portfolio companies a real advantage?
What is the competitive advantage?
Arbitrage? Right. And if the answer is they're kind of like everyone else, then it's really hard to see. So yeah, it's founder, but there also has to be this is how we're going to make money. This is why people are going to part with their hard-earned money to purchase our product, our services, and this is how we're different than everyone else. And if you can show me those two things, it's very likely that I'd be interested in investing. But just by flashing the words AI a lot, like that doesn't mean anything.
Story plus math.
Yeah,
potential
exactly. Or that basically that's what early stage VC is, right? A little bit of pixie dust, a little bit of math.
There you go. There you go. Some fundamentals. All right. I want to switch gears to the election and
sure.
Last couple of minutes with you. In your conversations that you're having with other folks in the VC community, how much enthusiasm are you seeing that aligns with yours for the Harris campaign?
I mean, exponentially more than we saw with Biden, right? There was.
How come, Bradley?
I mean, there was zero because I think that when you asked voters writ large, when it was Trump and Biden, are you happy with the choices? It was just overwhelming, like 80% no. It was very hard to get excited about an 81-year-old guy who, especially in the world of tech, didn't know anything, right? Like he couldn't tell you what AI stood for or anything else like that. Look, I don't know if Harris is going to be incredible on tech or not, but at least she's not 81. She comes from California, Northern California, has familiarity with Silicon Valley, will be better suited to understand issues that we care about. And some of her appointments will have to be better. So for example, when you had Pomp on a few minutes ago, you guys were talking about sort of what he thinks will happen in terms of regulation. Whether it's Trump or Harris, odds are Gary Gensler will not be the SEC chair again next time. For crypto, that's great, because you literally couldn't be worse than Gary Gensler. Lena Khan, who I do think has done some good things when it comes to sort of big tech antitrust prosecution, has also been a real deterrent around regular M&A, which has hurt venture liquidity. Odds are she's not getting another 4 years as FTC chair, even if Harris gets reelected. That's meaningful. So a lot of this with this election is less about what are their policies and what do they have in their party platforms, because that stuff goes in the trash the minute the election's over. And it's really, who are they going to appoint? Who's going to be their Treasury Secretary? Who's going to be their Justice, their Attorney General? And that's really where the rubber meets the road on this.
Well, Bradley, when you're talking to, let's say, Wall Street donors, are they equally enthusiastic about Harris?
I think that they are a lot more enthusiastic about Harris than they were about Biden. And so then it gets back to the question of, look, when you were asking the question of purely what's best for my pocketbook, you can make an argument either way, right? You could say, I think Trump will be better on crypto, or Harris will be better on AI, or whatever it is, and you're sort of guessing here or there. And then there's the secondary question of like, what kind of world do I want to live in? Look, I have been very publicly for Harris, and it's simply because I don't know which president I'll make more money or less money under, but I know that it was just really stressful for me when Trump was president. It was just chaos all the time. I don't like living in that. By the way, as newscasters, you guys might love it, right? It might be much better for your business model than someone who's kind of quiet and boring. But for me, at least, like it's just, I don't want to live with that level of uncertainty and stress, and I don't think that's good for the economy either.
Last question. Obviously, Harris and Walz tonight, first big interview. What's a win for them? What do they need to accomplish?
Make no news. Look, whether or not, and really I should be asking you guys this question, which is, she's been on a 5-week honeymoon now, however long since Biden dropped out of the race, and we've got about, 10 or so to go till the election. If the mainstream media is going to sort of keep this all the way through the next 10 weeks, she's in decent shape. It's still a 50-50 election, but she's in decent shape. If at some point the media says, okay, our job is to start asking really hard questions of someone who wants to put themselves in front of the voters to be president, the math might change a little bit. So I'm curious to see how Dana does tonight.
If she says to CNN, she starts talking about her tax policies, I want higher taxes on people, companies, unrealized gains, how do investors react to that?
Badly. Now look, she's a smart lady, right? And I think what we saw in her speech the other night at the convention is, she knows what she's doing. She is not going to probably make unforced errors. Her team is pretty smart. So I don't expect her to say things that will wildly just upset the market and upset Wall Street. But yeah, as a Democrat, she is certainly balancing multiple constituencies, right? So she's got the center where she tends to reside a little more. But, she needs the left also. If they've got to come out and vote, just like Trump needs some version of the center and he needs the far right. And on things like abortion, he's balancing those two issues. She's balancing those two issues on things like taxes and the economy. And so she's going to walk a fine line, and we'll see how well she can walk it tonight. But I don't think that CNN is going to rake her over the coals too much. If you could somehow bet on the likelihood of this being a positive interview for her, I'd bet that it probably comes out just fine.
But it sounds like you think her tax policy is going to get rolled back if she makes it into the
I think
House.
ultimately, we don't know who's going to quite take the center of the House, but it's going to be close. The fact that we're 10 weeks out and we really have no idea means we're not talking big margins in either direction, which means getting anything through Congress, whether you're Trump or Harris, is going to be virtually impossible. So, I wouldn't take anything they're telling you they're going to do that requires an act of Congress at face value, because the likelihood of them passing it on either end is really low.
Bradley, great to have you on the show.
Thank you guys for having me. I appreciate it.
Fantastic to have you. And by the way, Bradley's new book, Vote with Your Phone, Why Mobile Voting is Our Final Shot at Saving Democracy. That is available September 17th.
Let's get to those Lululemon earnings. Second quarter earnings are out. You can see the stock under a bit of pressure in the extended hours here. The company missing on second quarter revenue and missing on third quarter guidance estimates. Just to run through a couple of numbers here, there was a repurchase of nearly 2 million shares in the second quarter of 2024. Gross margins coming in at 59.6%. That is above the estimate of 57.7%. It's interesting. We're seeing the shares actually recovering a little bit. They were under pressure, sliding over 3% earlier, right after the report drop, and now we are seeing a little bit of recovery. And again, that net revenue coming in 2.34 billion is 2.37 billion. That is a little bit under the estimate of 2.41 billion here.
2024 has been rough for this name. That's about as diplomatically as I can put it. Stock has been smashed. It's down about 50% year to date heading into this print. And of course, last month, remember, Maddie, we had this whole product quality issues with their new so-called breeze-through leggings. They had to pull that product from the shelves. Bulls, though, and there are plenty, in fact, most on the street are bullish on this name, talk about growth opportunities, strong cash flows, strong balance sheet. So it'll be interesting. We'll hear more on the call.
Yeah, I'm fascinated by why it's recovering a little bit. It's bopping around, so we're going to figure out.
Now you're hugging the flat line again.
Yeah.
All right, moving on. Ulta earnings, they are out as well. And Brooke DePalma is back. Here with more, Brooke.
I certainly am back, and unfortunately, the glow up for Ulta may be coming to an end here. The company did miss on all key metrics: revenue, same-store sales growth, and earnings. If you take a closer look at those numbers, revenue came in at $2.55 billion. It also missed on earnings. That came in at $5.30. And we saw a same-store sales decline of 1.2%. Now, that's opposite of the 1.3% that Wall Street had anticipated. And all this really led the company to update its fiscal 2024 outlook. It now expects same-store sales to fall between 2% to flat. Now that's down from the previously expected outlook of a jump of 2 to 3%. And now CEO Dave Kimball saying in the earnings release that they have actions underway to address the trends. They're focused on driving stronger sales and traffic and continuing to exercise financial discipline. But this is a far different story, guys, than what we've seen previously from this beauty retailer. You think about Q2s in the two previous year. We saw an 8% increase in 2023 for sales growth and a 14.4% back in 2022. And so could this glow up be coming to an end? Perhaps.
All right, we shall wait and see. Brooke, thank you for a second time. All right, Lululemon shares searching for direction after reporting mixed results for the second quarter. Company also slashing its full year guidance. And joining us now is David Schwartz, equity analyst at Morningstar. David, listen, I know you haven't had much time to look at these numbers, but give me your first take, your first read through the print.
Yeah, it looks like it was a pretty difficult quarter, but I think everybody expected that. Sales were down in North America. And at this point, I think that was widely expected. So I think that's why the stock is not really reacting too much to the report. And the guidance was cut for the rest of the year. Again, I think that was widely expected. People knew that the breeze-through leggings had been pulled from the stores, and that was likely to affect the third quarter numbers. But still, Lululemon has very strong profitability. The bottom line number, $3.15, was above my estimate. And, that was despite the fact that the sales were a little bit light. And that's because Lululemon had a very strong gross margin. So it appears that Lululemon did sacrifice some sales in the quarter to keep its prices high and keep its gross margins high.
I'm looking at one stat here, sales jumping 29% in Lulu's international markets as they're looking to expand in China. Where would you rate that on Lulu's executive orders in terms of things that they could do to save the company stock moving forward here? Is that a narrative shift that they should really be zeroing in on?
Lululemon has already been doing that, really. I mean, if you look at where the stores are being opened, most of the store openings now are happening in China, not in North America or Europe. So Lululemon is really pushing hard in China, and so far the results are really strong. You talked about double-digit sales growth again this quarter in China as well as the rest of the world. And so in China, Lululemon is seen as even a more premium product than it is in the United States. It's almost a luxury product in athleisure in China. And the number of stores that it has in China is less than 200 stores. You look at other companies like Nike and Adidas, they have thousands of stores. So the upside in China for Lululemon is very, very high.
What about, I heard other folks on the street, David, in terms of, potential growth drivers, they'll talk international, they'll also talk men's. Do you agree? Is that also another potential growth driver here?
Yeah, men's is about a quarter of Lululemon sales, and it is growing fast. However, it's probably not going to grow as fast as the women's business because it's still known as a women's athleisure company. But we do know that in sportswear, men's wear outsells women's wear, and that's different from most parts of apparel. Generally, women spend more money on clothes than men do, but that's not the case in sportswear. So all Lululemon really has to do is keep the men's business growing, and it could be many multiples the size of what it is today. It's still relatively small. Now, it does come into more direct competition than with Nike and other sportswear companies that, of course, have very, very large businesses in sportswear.
I want to switch gears a little bit and talk about Gap. Definitely an interesting reporting for them today. So I'm curious your take on the release of those earnings inadvertently ahead of the opening bell here. But just your main takeaway from the earnings print. The numbers were solid, but a little bit mixed depending on which brand you're talking about for Gap.
Yeah, so Gap has a nice looking investor website that seems to have been updated. And there seems to have been a problem because the earnings leaked out today before they were supposed to. But, the quarter was pretty good. The sales for each of its four brands were a little bit above my expectations, very close. And the earnings were better, 54 cents versus my estimate of 38 cents. And there was a very strong gross margin, like Lululemon and other apparel companies that I've covered had a very strong gross margin in the quarter. It was probably its strongest gross margin in years. And we have seen that from others. Shipping costs are down, cotton prices are down, a lot of raw material prices are down. That's helping a lot of these apparel companies, even when sales are not particularly strong, to post high gross margins. You mentioned that some of the brands were not as strong. Certainly Athleta is still weak, but Old Navy really drives Gap's sales and profitability, and Old Navy appears to be back on track.
And David, what do you make of the CEO there, Richard Dixon? I'm curious just how you would grade his performance at this point.
Well, so far it's an A+. Grading on a curve is pretty easy because, to be honest, Gap has been mismanaged for about 20 years. So there's been a lot of turnover at Gap's management, and the Fisher family has not exactly done a great job of managing the business over the decades, really since Mickey Drexler was fired over 20 years ago. So right now there's a lot of enthusiasm with Gap, and it was not long ago that the stock was in the single digits, and I was perhaps the only Wall Street analyst who actually was recommending the stock at the time. I do think that we've seen a very rapid turnaround and a lot of enthusiasm at Gap that we haven't seen in a long time.
David, always great to have you on the show. Thanks for joining us.
Thanks.
And coming up, shares of Affirm skyrocketed today on the back of their latest earnings report. I am speaking with the company's CFO, Michael Linford, on the other side to break down those numbers. The Dow closing at another record, the third time this week, while the S&P 500 and Nasdaq waver. Yahoo Finance's very own Jared Blickery joins us here with the trading day takeaways. Jared.
You know what? It's a cyclicals. That's what it is this week. It's a cyclicals, not necessarily growth. Tech's taking a back seat. And let me show you the price action. We've had 4 days in the bag here. We got 1 more until we close the month of August. Here's 4 days. So financials is actually the #1 sector this week. So that's a cyclical. That's kind of a value sector, more value than cyclical. Then you have energy, arguably defensive. Then you have industrials, that's cyclical. Materials, that's cyclical. Healthcare, well, that's defensive. So is utilities. But you see where we're going here. This is kind of a broad swath. And as I promised, tech is taking it on the chin. So is this other mega cap sector that's consumer discretionary. But something really interesting. Let me just show you the year-to-date totals. Financials is now #1. You might not would have thought that, but it is. And Berkshire Hathaway, which is now a $1 trillion company, that is the biggest stock in there. Thanks to Geico, it's considered financials.
And so, okay, so cyclicals lead the way.
Yes.
So all clear, risk on. That's what that means?
Well, the thing is, like,
no, it doesn't. Okay.
No, we got a lot of gas in the tank here from a charts perspective. I could show you industrials. This is the year-to-date chart, how they've just kind of broken to the upside there. You could see them continuing. I could say the same thing about healthcare. I could say the same thing about materials. But we got to get into the next topic here, because the dollar itself could be a headwind. And this is my #2. The dollar is reversing on Q. So remember, it was just a couple days ago we were talking about the potential for a dollar reversal, and it's kind of a longer term play. But that's what I'm seeing in the Dixie right now. This is a 2-month chart, and you can see here those two green up candles right there. But in the context of the larger picture, the bigger picture, this is a 3-year chart. The reason I thought that is because we're just getting down by potential support. And this isn't a very straight line, but we're probably going to go from somewhere down here to somewhere up here. And it matters how fast we do it. Fast is bad to the upside.
Well, that's what I want to ask you, because I remember we were talking about the greenback, and you had some advice when you see this rising dollar in terms of what you want to see as an investor, what you don't want to see.
Yeah, so the U.S. right now, you actually don't want to see the U.S. as the best performing country in the world. You want emerging markets to be doing better than this. You want the tailwind to be at other countries. But if you see the dollar shooting higher, that could be a signal that people are risk averse. So that's why I'm saying the speed of the move matters. If you get the dollar shooting up quickly, that's going to be a problem for risk assets. It would be better if the dollar broke down here, but that's just not the pattern we're seeing right now.
All right, Jared Blickery, final point.
All right, we are going to look at an interesting development this week in August, and this is a volatility shock. So B of A, I was just going through a note they published recently, and they actually found that August is a pretty common month to have spikes in the VIX or also down movements in stocks. So we have something in statistics called standard deviation, or anytime you have a 3 standard deviation move, suffice to say that happens, something that happens once in a very long while. Well, in August, you tend to have 38 of these historically, and that's second only to October. But if you're paying attention here, August, September, October, these are some of the highest months, and this is when you see the VIX really acting up. So primetime crash season is here, and that's why I'm saying even though we have these sectors set up for potentially higher runs, we do have some headwinds in the form of the VIX and the fact that the buyback window, this is something that we've covered in recent weeks, the corporate buyback window, that's closing in September 6th, that's next week, and that's because of earnings. So a lot of the tailwinds are just kind of evaporating.
You mentioned the VIX. I mean, what do you typically see for the VIX this time of year?
Well, I'm glad you asked, because this purple line is what the VIX has done this year, and the cyan is what it does on average. And these are two, we fit these so that they both appear in the same chart here, but they have 2 different y-axes. What I want to show you here, this spike here, this is what happens in the average year. We got a spike this year, an actual spike that was perfectly on schedule for that. So what I want people to pay attention to is right here, this is the time of year that the VIX tends to trend up, and this is where we are right now. So draw your own conclusions. So my point is, all of these tailwinds that we had, they're becoming headwinds, and so that's a little bit more caution that we have in the markets.
All right, thank you, buddy.
You bet.
Appreciate it. We move on. Affirm pleasing investors, and that is an understatement. After topping fourth quarter revenue estimates, the buy now, pay later service also posting narrower than expected losses per share. company also saying it expects to be profitable by the fourth quarter of the next fiscal year, ahead of Wall Street estimates. And joining us now for more is Affirm's Chief Financial Officer, Michael Linford. Michael, it's good to see you. So listen, you reported investors like what they saw. That stock really surged on that release. Walk us through the report, Michael. What are you seeing driving the business?
Yeah, thanks for having me. Look, we had a lot of momentum in the business right now. We delivered really great results. We've got a fully engaged team, and there's so much opportunity ahead of us. We're really firing on all cylinders, and our outlook reflects that. We see strong growth, margin expansion, and we're signing up for 200 basis points of adjusted operating income margin expansion. And we announced that we're on a path towards GAAP profitability. And I think it's all just a reflection of the unstoppable team that we have here at Affirm.
Let me ask you, Michael, I was chatting with a financial analyst today who covers you all, smart guy, and we were talking about the results, and he said, I just wonder how conservative Michael is being here with his guide, just given the big volumes in Apple Pay, he said, the big opportunities with rate cuts. He was curious whether you're being kind of just conservative with that forecast. What's your response to that, Michael?
We take our guidance very seriously. So when we set out to provide guidance for the fiscal year, a thing that we did this year and last year is we set a floor for what we expect the GMV to be for the business. And that is a reflection of things that we know are tangible and real, in the ground, already shipped. And then we set out to try to do better than that. And we put a lot of blood, sweat, and tears into delivering more for our consumers, more for our merchants. Last year in fiscal 24, we did that very well. We set a reasonable number to start the year out at, and went out and did a lot more than we committed to at the beginning of the year. And I really hope we can do that again this year. But we're very thoughtful about making sure that we size the investment envelopes in the business and size the numbers we communicate externally to things that we have a lot of confidence in, as we think it's really important that investors know when we make a commitment, we do everything we can to deliver on it.
Michael, another focus for investors is that Amazon relationship. How much bigger do you think Amazon can become here as a partner?
For all of our partners, I think we're still in the very early innings. The category as a whole is still in this secular shift where consumers are adopting these new payment methods. They're moving away from credit cards. They're finding better ways to pay for things over time. And when you partner with the world's leading merchants, the world's leading e-commerce and merchants broadly, you have a lot of opportunity ahead. And our penetration is still very, very small. We noted in our letter, we're still, roughly 2% of U.S. e-commerce, and that gives us a lot of confidence. There's just tons of runway. And so whether it's partners like Amazon or a partnership with Shopify or adding new merchants, we see a lot of runway ahead of us.
You print these strong results, and investors clearly liked it, Michael. I'm just curious, though, at the same time, signs of caution with the consumer. For your investors right now, how concerned should they be about that, Michael, given, softening economy, rising unemployment rate?
I think we saw real signs of strength in the consumer in our data, in our consumer last quarter. One thing that I like to point people to is the real strength in categories like electronics. And I pick that category because you saw that category see a lot of headwind over the past year and a half, and it showed signs of life in our Q3, and then in our Q4, it started growing very quickly. And I think that's a reflection of that consumer being very engaged. And I don't think it's unique to us. I think there's pockets of that elsewhere in the economy. And for us, it doesn't matter as much where the consumer is engaged, as long as they're engaged somewhere. We're so broadly distributed that we're able to be beneficiaries of that. And last quarter, we saw that. And on the credit side, we really are continuing to see results come in line with our expectations. And so I don't know about the consumer outside of Affirm, but I do know that our consumer at Affirm is engaging in a really constructive way and delivering really good credit results.
Michael, you do have obviously rivals in the space, right? Think Klarna, Afterpay. How big is your total addressable market, Michael, when you think about it, and how fast is it growing?
Yeah, the category is growing very quickly, and the addressable market is big and expanding. The category is, again, it's part of this secular shift where consumers have decided that they'd like to move away from credit cards and find alternate ways to pay for things over time. And we think the penetration rate is, several multiples of where it is today, and that's in an end market that's still very growthful. E-commerce still has underlying growth in it. So we really don't feel like we're constrained by the addressable market anytime soon. There's $1 trillion of credit card debt out there, and we're just a small drop in the bucket compared to that. So we have a lot of runway again, and we're not feeling constraints around bumping up against addressable markets. And that's why, a 30+% growth rate in GMV isn't really that surprising in our business.
Michael, always appreciate you coming on the show and take the time to walk us through the results. Thank you.
Thanks for having me.
Don't go anywhere, and we're asking for a trend right on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
A large portion of Nvidia's revenue is coming from a small number of big tech companies, and Yahoo Finance's Madison Mills joins me now with a closer look. Maddie.
Thanks, Josh. So taking a look at this chart here, you can see that 40% of Nvidia's revenue comes from just 4 names here. But what's important is what those names are, right? These are the biggest tech companies in the entire world. I'm talking about Microsoft, Meta, Alphabet, and Amazon. Tiny chunk here from Tesla. But as you can see, Microsoft is the heavyweight in the room, making up 20% of Nvidia's revenue here. Then you've got Meta, about 10%, tiny chunk here from Tesla, and about 5% from Alphabet and Amazon here coming up at the end. So taking a look at this entire chart, the reason I wanted to pull this is because this presents an interesting question here, right? Is it a problem or a benefit to Nvidia that it is relying so heavily on just a handful of companies? If you hear from Microsoft CEO Sundar Pichai in their earnings print, he said that under-investing in AI was a bigger risk than over-investing, and indicated that AI spend for the company was really just getting started. Now, maybe some of these big tech firms were spooked by Wall Street being concerned about the ROI on AI CapEx. That's certainly been a theme for this earnings quarter. But we did speak with Angelo Zeno earlier in the program about whether this level of revenue concentration could be an issue for the tech giant. Take a listen.
I'd actually personally rather be kind of tied to these hyperscalers than I would the consumer, to be honest with you. And a big reason for that is when you kind of look at the revenue trajectory of these hyperscalers over the last 2 decades, they're much healthier than the consumer themselves. So in many respects, I don't necessarily think it's a bad thing.
So Josh, I think this is really interesting, and I know I keep talking about this interview yesterday like a broken record, but we had this interview with a big Nvidia bear, and when I asked him this question, he said to me kind of the opposite of what we just heard from Angelo. He said it's the most bearish thing that he has ever heard, that just this basket of companies is responsible for such a huge chunk of Nvidia's revenue. But again, when I look at these companies' balance sheets and I think back to even some of the analyst notes, not just the earnings calls, we have a guest that was on the show earlier saying that Meta is actually the key AI play. That seems like a positive to me. We know that these companies are going to continue to widen their AI capex moving forward. We know that Meta is increasing capex into AI, taking it away from some other parts of the business like Reality Labs, for example, putting that money into AI. And right now, there's not a big enough competitor to Nvidia to really make it seem like that money is going to be going to another company. I think that's going to be the next big question for investors. Are we going to see another heavyweight entering the room that could take a little bit of the market share that Nvidia has been able to maintain for so long here, Josh?
All right, Madison Mills, thank you. And time now for what to watch Friday, August 30th. Starting off on the economy, monthly PCE data, that's personal consumption expenditures for July, coming out ahead of the open. Economists forecasting both numbers could hold relatively steady at 0.2%, with no change in core PCE and total PCE to tick up. New data coming after today's second quarter GDP revision ticked up to 3% after an annual print of 2.8%. All of this data giving us more insight ahead of the Fed's interest rate decision in September. Multiple Fed officials, including Fed Chair Jerome Powell, signaling that now is the time to cut rates. Question investors are asking, of course, is how big will that cut be? The traditional 25 or a supersized 50 basis points. And it's Warren Buffett's birthday. He's turning 94, and it comes just days after his company, Berkshire Hathaway, hit $1 trillion in market cap. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.